Welcome back to the stock portfolio review videos. Currently, my two stock portfolios sit at a combined value of over 102,000 AUD. That's made up of the $57,688 in my stake portfolio and the $44,597 in my Vanguard portfolio. If you've been keeping up with the news, you would have seen stocks have really crashed recently. And overall, my stake portfolio is now only up $10,000 exactly, or nearly 21%, when previously was high as 34% up in the green. My Vanguard portfolio isn't down as much as it isn't as volatile as it's mainly ETFs, but it's down over $1,000 to $2,000. So, having a look through my portfolio, I have been doing some investments. I've been doing some shorts, tracking and trying to keep people updated on what I've been buying. But if we have a quick look through my portfolio, starting from top to bottom, you can see Apple, I did recently sell out a little bit. So I took $1,000 out of my Apple position. So I still own $2,323 in equity, or around 9.7 shares. Previously, I believe it was around 13, but I sold $1,000 worth. I sold at around $240 a share, so quite good. And I used this money to invest into another position, which I'll speak about later. I'm still very good in the green in Apple. I'm up around 53% with an average price now of 156 per share. So it's been quite good holding for me. One of the reasons I decided to sell out of Apple compared to other positions is it's trading at quite an expensive PE ratio. As you can see, 37.58. I think it's a great company, hence why I didn't sell all of my position. But at the moment, I just find it a bit harder to justify the Apple share price, especially when I compare it to some of the other big tech ones that I can buy in, that I did buy in as well, which I'll speak on. I just don't see it having that same growth. I know some people are quite worried about Apple and their growth and if they're just a GDP growth company. But I still want to keep some of my position in Apple. I think it's a real staple. I think it's one of those companies where you could leave it for a few years, 10 years, whatever, come back and your position would be still in the green. I think it's a great company, so that's why I kept it, but I had to sell out of somewhere to make the most out of this opportunity. And Apple was one of the shares that didn't get hit as hard as what some of the other big tech stocks did. If you look in the last week, it's still down 1.7%, but that's nothing compared to others. In the last 6 months, it's still up 8.2%. In the last year, it's up 40%. So very, very good year. So I was happy to take a little bit of gains off the table and invest into another company. Next is the main company that I have been investing in, and that's Amazon. So as you can see now, I own 25 shares in Amazon and I'm up only 1.38%. So you can see if we have a look at the last year, it's obviously still up 12.69%. But if we have a look at the last month, you can see the stock is down 13.83%. So I've been an investor in Amazon for a little while, and I saw this as an opportunity to really buy into a company I believe in that was really trading at a discount. So you can see here, it was trading in the 240s and then had this really big market pullback. So when the stock dropped all the way here down to 213, I actually bought more shares. I bought around $2,500 worth AUD, and I thought that was a good time. I was buying the dip at a pretty attractive price, and then it continued to fall even further. I then proceeded to buy even more stock here at around $206 a share, around there, and now it's fallen even deeper, down under $200. So it's really continuing to fall, but I've hopefully used this as a good time to buy into a company I believe in. As you can see, the PE ratio is a bit lower for Amazon than it is Apple, and I see a lot better growth opportunities in Amazon. I think, obviously, there's been a lot of talk around the big tech with their CapEx spending. They're obviously investing a lot into the future, and that's kind of what you want to see with your companies. Again, I've got quite a long-term investment horizon ahead of me. I'm still 22, so I have a long-term kind of view I try to keep. And Amazon is a company, same as Apple, where I think I can invest money into it now. And if you give me 20 years without even looking at this portfolio, I think Amazon will still be there, still be a strong company printing money. So that's why I decided to invest in Amazon. I did a recent video kind of going through, I gave ChatGPT some information asking why is Amazon stock forward, and I kind of did a video kind of breaking down Amazon stock and just playing around with AI and just uploading that. It didn't get much views, but it was pretty fun and interesting to use. I've never done that before for stock analysis, and it's been quite good. in terms of my investment so far in Amazon. Obviously, with this me investing more and more, it's really brought my average share price up a lot. But again, I'm trying to keep a long-term outlook, so I'm not too worried about that. And I think long-term, I think the uses of AI will be really strong in Amazon. Obviously, there's a lot of companies out there that claim to be that AI can obviously increase the productivity and things, but I think Amazon can be a really good player in that. I've even seen they're doing work with chips, so they're not so reliant on NVIDIA. Obviously, that might be something that's in the future and a bit far away, but it's good to see they're taking the right steps long-term. But yeah, this is a company I invested in. Again, I did a recent video on it and I went a bit more in depth, but I'm really happy if I can keep buying it at this share price. If I have extra money, it's a bit annoying because I wish I had a bit more money sitting on the sidelines. I could be buying more and more. And obviously I did buy right before it continued to fall, which is a bit sad. But again, I think I'm buying to a long-term great growing company. Next is Google. So I increased my shares in Google as well. After its recent pullback, I was a bit cut that it fell under 170. I think I got in around 170. As you can see, I've got $5,335 in equity, or around 30.68 shares, and I'm up around 4.87. Again, I've been buying in more, so this has really lifted my average share price, and hence why the returns don't seem as strong. And that's why my overall stock portfolio's returns also have been coming down as I continue to dollar cost average into some companies I believe in. The stock is trading at around 173 dollars at the moment per share, and it's down nearly 7% in the last month. If we have a look at the last week, it's up a little bit. It's kind of rebounded. You can see those really low points here at 166, but I think people and investors try to snap that up at that price. The PE ratio is actually lower than what the S&P 500 is trading at, and if you ask me whether Alphabet or the average company across the S&P 500 will do better, I put my money towards Alphabet. Again, I still keep over basically 70% of my portfolio is in ETFs, broad market tracking ETFs, but I do enjoy investing in individual companies such as Alphabet, where I think I can generate alpha and just have a bit of fun, do these YouTube videos on, do shorts on, and kind of just keeps me engaged. I like investing in companies. Like I mentioned, Alphabet is trading a lot cheaper than many of its big tech rivals, like Amazon, for example. That was around 35 forward PE. I think Apple was 37. Microsoft is also in the 30s. But I think Alphabet is the cheapest out of the Magnificent Seven, I believe, on just pure PE ratio. And I think it's a good company. I think there's a lot of worries, obviously, people saying with the fears of its search dominance going away. I don't think it's going to be as big of a deal as people think, and I think Alphabet has a lot of smart people that will be able to innovate and stay on the forefront. Obviously, you don't, at the moment, AI capabilities are really good. It's pretty much, people are using it just as a search engine. But all of those major things, shopping and things like that, you still use Google for. Like flight tickets, I'm still going to go to Google to buy that. I went and bought new clothes, shoes, things like that. I still went through Google for that. Obviously, if it's a general search and I just want to get a split answer, just a straight answer, I will use ChatGPT, or I'll use Llama, Claude, whatever the case is, Gemini, which is obviously a Google product. But I think Google will be fine. I think they're going to keep innovating. They're spending a lot of money on CapEx again, which is one of the reasons they got hit. Investors obviously weren't too happy with how much they were going to spend. But I think, again, this is a long-term investment to show Alphabet is investing in its future. And that's what I want to see as a shareholder. Alphabet also started paying dividends recently. So you can see its dividend yield is quite small at 0.46%, but it is returning money to the shareholders. Historically, this is a company that didn't pay a dividend. And again, I'm not the biggest dividend investor. I always mention that. I'll go more into dividends later, but that's not my goal with investing, especially at my young age. I don't need the cash flow as much. I prefer if it's just reinvested. Also stops the double taxation and things like that. So if they can just keep buying back, even buying back shares, hopefully at a good price, and keep doing the right things, I think I will be happy with this Google position in another 5 years. So that's kind of my thesis going into it. Again, do your own research, believe in the companies that you're investing in, else you'll sell out at bad times, such as now when stocks are really down now. This probably isn't the best time for some people to be selling out, they probably left money on the table. They were probably confident in their positions a few weeks ago, months ago, when things were really in the green. Now things are in the red, people might be selling, which again means you're going to be selling at a discount. But do whatever's best for yourself. many of my big companies are really trading at a discount. Look at Microsoft. Microsoft in the last year is down 3.87%, which is horrible, especially when you see, for example, Apple was up 40% we saw in the last year, and Microsoft is by far a bigger position for me. I own around $5,345 in equity, so similar size to what Amazon and Google have now built up to, but I just can't justify selling at this price. It is quite rough. I really should have been liquidating some of the position back here when I was trading close to $470 a share, but I didn't. I wasn't on top of the game. Things fell, and now it's just too low for me to sell out. And I still believe in Microsoft. I still believe it's a quality company long term, so I'm holding on to that position. Like I mentioned, I try to keep around 50% of the portfolio in the S&P 500. So I use the ETF VOO. I believe it's now the biggest ETF. It overtook SPY. I think that's got to do with the fees, but it's great. I've been investing in it for a long time, and obviously things have really dropped off now, but I try to keep 50% of my portfolio in the S&P 500 ETF, just because I don't think I'm some amazing investor. I think a lot of investors think they're smarter than what they actually are. I have around 31 shares, and I'm up around 26%, or 3,500. And again, that's with me being dollar cost averaging over time, and my average share price is around $417. So again, it's up 11, nearly 12%, which is a good return for the S&P 500. Historically, people say aim for around like 10%. And I'm not complaining with a 12% per year return. Again, I am young, so I can take some risk with some other positions, but I like to keep around 50% of this specific portfolio in the S&P 500 for times like this when there is a lot of volatility in the market. That's kind of the main wrapping up for my stake portfolio. Again, if I have extra funds, I will be investing. I invested around, I think, $3,500 between Amazon and Google and so on. So I am trying to be proactive in investing and buy the dip. So I'm not just giving advice, I'm using my own advice as well, because this is something that worked really well for me in 2022. If you remember, if anyone was investing then, I'm sure many were, 2022 there was a really big dip in the market, and that really taught me a lot of lessons. So if we go in the 5-year, you can see here in 2021 things were sky high, post-COVID, things like that, and then it really had this poor period all through 2022 to 2023, you can see here. And I use this as an opportunity to buy in. All my old videos are still up on my channel of me investing back then. And back then, that was a lot of money to me. I think my portfolio was only worth like $15,000. But during this downturn, I really used the opportunity to buy into companies I believe in. And that's one of the reasons I'm so happy I do these YouTube videos, is I can go back and see this as I've documented it. And I got to buy in a lot more cheaper into quality companies, and that really allowed me to learn some lessons of holding, market volatility, believing in the companies I invested in. I lost some money selling companies I didn't believe in, so it's really taught me to anchor down in strong positions that I have conviction in. And then through that time, we moved on. 2022 came and went, and then 2023 started. And you can see the gains to 2024 was a great year again. So if there is a downturn this year, I'm not too worried. Again, I try to keep a long-term outlook. And yeah, I think I'm getting closer to 5 years of investing. So that's really good. And I remember doing these videos and saying in 5 years time. So now the next 5 years time, I'll be hitting that decade mark. So again, that's a big goal for me up to 2020 to 2030. So these are the initial years as I'm kind of building the portfolio. Again, it was nice to hit $100,000 across the two, but these are just the early days. So I plan on really investing, working hard now in my 20s to invest money now. So as I get older, these portfolios can kind of help with the compound interest and snowball effect. Having a look at my other portfolio, that's my Vanguard portfolio. This historically was a small portfolio for me, but it is catching up in market value. So you can see I have around 15,600, used to be in the 16,000s, in VLC, which tracks the Australian Large Companies ETF. It's trading around $81 a share. It was previously at highs of 86. And again, this just tracks the 20 biggest companies here in Australia. And I am kind of using this money as towards almost like a house deposit as well. If I am to liquidate any of my share positions, I am going to probably liquidate out of VLC. I don't have as much conviction in it going forward. It pays a strong dividend, but like I mentioned, I'm not a dividend investor, so everything I get, I just reinvest. But yeah, I might use my cash and then this as the year goes on to potentially look at purchasing a property. Next is VGS. So this is a position I'm maybe looking at investing a bit more money into soon. So I might transfer some money out and put some money in here, as it's traded under $140 a share, so 138. And this is kind of more of a global ETF. This holds around, I think, 1,500 holdings from US mainly, Europe, everywhere pretty much except Australia. So Japan, Asia, whatever. And yeah, I've got a decent amount of money into it. I can probably get that up to 30,000, which would be nice. I own 209 shares in it, and it's been pretty good. I think one of the benefits of this Vanguard portfolio is it doesn't experience as much volatility as my stake portfolio does. And as this gets closer, like I said, I'm only around 30% of my stocks, individual stock holdings, or maybe even less than that. It's more ETFs, so it's kind of good in that sense. I get to have the fun of picking stocks and having a bit of fun doing shorts, doing YouTube videos on it, while I still obviously keep the diversification and my long-term outlook in Vanguard. It's also cheaper, less fees, which is nice, especially it hurts transferring money over with the foreign exchange fees and things like that. So that's one of the benefits and why I keep putting money in Vanguard. If we have a look at my Excel spreadsheet, you can see here I've updated the figures to kind of how things are kind of weighted. I need to go in and reallocate funds. As you can see, VOO is dropped well under 50% now. It's around 46, just because of how much other positions have spiked up because of Amazon and Google popping up to 15 to 14% respectively, and Microsoft still being 15%. It's kind of chunked away at my VOO position, but I will fix that and I'll allocate that over time. Next is my Australian one. So you can see it's around 65, 35. Again, I'm probably going to get that down to around 70, 30, just because I believe there'll be better growth opportunities in VGS compared to VLC. And this is kind of how the portfolios have been looking over time. I track this at the very last day of each month. I update it for the next month. And you can see my stake portfolio value went down, obviously, as the market turned down. And my Vanguard one's been going up as I've been investing more. But I do these every single month. I keep putting videos out, kind of tracking this and holding myself accountable. And I will probably make this a bit nicer. I know I've been saying that for a long time, but it does get the job done, and just tracking and kind of giving a visual example of how things are looking between the portfolios. Next is dividends. In terms of last month, I got $4.28, I believe I mentioned. So not much in dividends, but I'm not too upset with that. Nothing in the Vanguard one, as that's quarterly. That's how the portfolio is looking now. I'll just keep dollar cost averaging, and feel free to share how your stock portfolios are doing.